Hope everyone's well. Looking out of the window, the sun's shining. Looking at the markets this morning, they're up, and we look at hopefully City will go and win the treble. So it looks as if everything is hunky dory. However, I think we have to take a little bit of a step back and just have a look at, is everything perfect? Are we out of the woods, or do we have to go forward with a hint of cautious but also some optimism? So today we'll be discussing what's happened in the markets, what's driven the recovery of equities that I've just mentioned, and what we can expect to happen going forward. And Alex will be summarising the impact of this on clients' investments. I think it's safe to say the last 18 months has been quite a difficult 18 months, if not 3 or 4 years, with high volatility in the markets that have affected most of our clients' fund values. I can honestly say some of the reviews and discussions that I know the advisors have had at Pareto have been quite difficult. But as always, our advice is about time in the market. It's something, Alex, you've always advocated also with regards to the investments, and not allowing any short-term market movements affect our long-term goals and objectives. So again, I would reiterate to all of our clients that are listening in, as I do in all the presentations, the importance of having regular reviews with the advisors, and to ensure all of your plans are still on track to achieve all of your goals and objectives. It's also essential that you regularly review your risk and volatility, and our advisors will be happy to assist you there. For those of you who regularly dial in, the last quarterly update back in January, I think the overriding summary was that we're going into 2024 with an expectation that inflation will be falling. Also an expectation of global and central banks easing the monetary policy, and what the knock-on effects of this would be on interest rates, with the expectation coming down. 2 of those things have happened, and I think Alex will touch on these. And although interest rates have not come down to the expected levels and timescales we expected them to, I think the markets have probably priced those in. So just before we start, I'd like to start with some housekeeping. To mitigate any background noise, can we ensure that everyone's on mute? It should already be. For the presentation, it's being recorded and will be available via our YouTube channel and online. The webinar should last around 40 minutes with questions and answers at the end, and these can be taken by typing in to the Q&A bar at the bottom of your screen. So moving on, Alex, would you just like to give us a brief update on what is happening with regards to the UK economic growth, with what's happening with economic growth in the UK and globally?
Yeah, thanks, Stuart. Morning, everyone. So let's start with the UK. It was announced in March that the UK is technically in recession. What that means is we've had 2 quarters of negative growth. So the second half of last year, the UK was in recession. The good news is that recession is probably already over. We've had 2 readings of January and February GDP data. Both have been positive. And we also look at other information and other data. I'll just share my screen just because it might be useful just to put this chart on. Here we go. So what I'm talking about is just on this right-hand side of the page here. This is Purchasing Manager Indices data. And the reason we look at them is because GDP data comes out with a bit of a lag. So as I said, it was announced in March that we're technically in recession. You can see that's kind of 2-3 months after the event. It's not really very useful. Whereas PMI data is survey information, which is live. And you can see there that both the manufacturing, which is the grey line, and the services, which is the purple line, have popped up over the last few months. So there's economic data is certainly improving within the UK. So you've had 2 readings of GDP, monthly data, which have been positive. You've seen this PMI data, which is improved. So that's certainly been a positive for the UK economy going into this year. I think the other point I'd make is just on this left-hand chart as well. So this looks at the different components that build up the economy and the economic growth within there. It goes all the way back to 2012. So you can see between 2012 and just before the pandemic, we were in that kind of low, boring growth, nice, didn't feel like it at the time, but it was kind of an ideal environment to be in. Clearly, we went through COVID. And then you can see that purple line just towards the end. It's really just flatlining. It's probably going to be, can't even tell whether it's gone negative. So it's likely to be the shallowest and the shortest recession that we've ever had. So I think there's a lot of bad news that's circulated, but basically last year economic growth was just bouncing around zero, and we just dipped below for 2 quarters after the first 2 quarters of 2023 have been positive. But it already looks like that's reversed and the UK economy is doing better. So that's the UK. Just taking a step back, then you also asked about the global economy. It's pretty similar with the global economy, to be fair. All economies go through similar forces at the same time. So the UK and Europe are very much aligned, and they have similar factors impacting their economy, whether you think about the high inflation that we've had, energy prices, etc. So Europe is starting to rebound, which is good. Stronger data out of China, which matters because China is the second biggest economy in the world. So that's been a slight positive going into this year. The real driver, though, for economic growth globally this year and last year has been the US again. The US economy has been extremely resilient, and a lot of that has been driven by savings that people are spending that were accumulated still from COVID, and that's keeping the US economy going. So UK, better economic growth this year, very mild technical recession, not really noteworthy. As I said, it's probably going to be the shortest and weakest recession on record. But globally as well, economic growth has been pretty strong. And, you go back to one of your opening comments, Stuart, was why our market's been so strong. And it has been this growth surprising on the upside, which has really driven equity markets higher over the last 6 months or so.
Good, thanks. I mean, one of the things that have been scaring markets over the last, particularly 18 months, is inflation, which is what you mentioned, that's been worldwide. Some inflation figures out today. I think inflation has come down, but not to the expected levels. So can you just give us your thoughts upon inflation, what's happening, where we think that's going, why it hasn't come down as quickly as what we expected?
Yeah, so for those who haven't seen, inflation, this is Consumer Price Index, CPI, it was announced today, and it came in at 3.2%. Now, that's fallen from last month of 3.4%, so it has come down, as you say, Stuart, but the expectation in the market was it would come down to 3.1%. I think there's probably a couple of reasons why it's not fallen by as much. The first is we're still getting quite a lot of wage inflation within the UK because we've all been having high inflation. We've all been knocking on our boss's doors and saying, please can I have a pay rise? And on Tuesday, we got the wage inflation data out, and that came in at 5.6%. So you can see that wage inflation is still running quite high, but it is coming down. So it's certainly coming down significantly. The other is probably a little bit of this geopolitical issues that we've got going on within the world. You've seen the oil price tick up over the last few months. That's not having a massive impact. I mean, we haven't gone to the levels that we got to when Russia invaded Ukraine, but certainly that's going to be having an impact. And as we know, some of the issues within the Middle East is going to impact supply chains as well. So there's a few reasons there why inflation is probably a little bit stickier than we'd expected. I think the important point though, and I'll just share my screen again on this, is just how far it's fallen. And I think we sometimes just don't take that into account too much. A year ago, this time a year ago, inflation in the UK was 10.1%, 10.1, and we're now 3.2. So in a year, inflation has fallen significantly. And this just shows the chart here. So it goes back to January 21. Again, shows the different components that make up inflation. It's blue being services, core goods being green, purple being food. You've then got the electricity and gas shock in grey. You've then got fuels in that kind of limey green colour. And then you put them all together and you get that orange line. Unfortunately, because it was only out today, this chart's out of date, so it doesn't include the figures from today. But the reason why it fell again from 3.4 to 3.2 was actually all driven by food, alcohol, and tobacco. So that purple bar there has just come down a little bit. And the data today is encouraging. It's not as encouraging as people would have wanted, but we're certainly still going in the right direction with inflation. So that's important. And today it was the lowest level for 2.5 years. So there's certainly a lot of positives that you can take from it. And I think economists are very good at saying where we've been. They're not so good at saying where we're going. What I would say is that there's reasons why you can see inflation still falling over the coming months as well. That being said, as we've seen within the US, and it has been a bit more sticky in the US, that inflation can have pop up a little bit for the reasons I mentioned, because of oil markets, global supply chains, and wage inflation still coming through to a certain extent. So I don't think we're out of the woods yet, but I mean, 3 number as opposed to a 10 number is certainly more welcome by the Bank of England and all of us for sure.
And on the flip side of the coin, when we've had high inflation, we've also seen high interest rates, maybe not historically, but certainly since 2008, since the financial crisis. And the Bank of England's having one of the highest base rates in the developed world. When do we think we can start seeing interest rates being cut by the Bank of England? So I think some people thought it may have started already.
Yeah, I think that was a bit premature. I think as we were going into this year, I think bond investors basically got a bit overexcited and thought March we might see cuts. That was never our kind of view. We always thought it'd be more towards the summer, to be honest, and that's still our view, that you probably see interest rate cuts towards the summer. There's a few interesting points that came out in March on this. So the first one, the governor of the Bank of England has said that inflation doesn't have to get back to the 2% target before they start cutting interest rates. So that's quite an important development. So we're at 3.2, let's say we get to 2.5 or something like that by the summer, then that should give the Bank of England enough room to be able to do it, but it still needs to fall a little bit further. The second point is you've actually seen one central bank already cut. So the Swiss National Bank have cut Swiss interest rates already. So that was in March. You've had other central bankers talking very aggressively about interest rates coming down. So you've had Christine Lagarde at the ECB talking about it only last week, saying interest rates are likely to come down in the summer, and she said June. So it looks like the ECB will probably go June. The trickier one's probably the Federal Reserve. As I mentioned, the inflationary data out of the US has been a bit stickier. We had a reading last week that was surprised on the upside a little bit. It looks like US inflation is actually starting to go up in the short term. So that might delay the Fed a little bit from cutting interest rates. And that's an interesting dichotomy, because normally what happens is central banks follow the Fed, because the Federal Reserve is the most important central bank globally. So they almost move first and then other central banks follow. But it now looks like you'll see the ECB and Bank of England potentially have to go before the Federal Reserve, just because the US economy is a lot stronger compared to UK and Europe. I think just going to share again, apologies for jumping around, but I think the other important point with interest rates, though, is just put it into context of where we've been. You touched on it before. This is the highest level that we've had since the financial crisis. So in 2002 to 2008, we're in that range of kind of 3.5% to 6%. And then we went into the financial crisis. Banks were failing, economic growth collapsed, and interest rates were cut dramatically. As well as that, you have to remember we're also doing quantitative easing, which is additional form of monetary policy easing to try and stimulate the economy. And what's happened is we needed this to happen for banks and to adjust their balance sheets to a certain extent. But interest rates were kept far too low for too long. And when you have interest rates and basically free money, it means that people don't take risks that they shouldn't do. They take on too much debt, And, if interest rates go up, we're then extremely more vulnerable to that. That's something we're mindful of when we're buying companies at the moment. We don't want to be buying companies with a lot of debt, because when they're coming to refinance that, the cost of that debt's going to be increasing significantly. So it has been a significant increase in interest rates because of this high inflation that we've had. But the pressure, as I said, should start to ease, and we expect to see interest rate cuts. And I don't think there'll just be one. I think there might be several over the coming months and years to bring interest rates back down to a kind of more normal level.
Yeah, I mean, I know we've been talking, Alex, in preparation for this, and we mentioned about Super June, so let's start a hashtag with regards to Super June. But you've got the Fed meeting on the 6th of June, the ECB on the 12th, and then the Bank of England meeting on the 20th. So that might be the turning point, would you say? And if it is, I know the Bank of England, because they've only got one tool in the box, everything has to be a nail. They've only got a hammer in the box of tools, everything has to be a nail. So when do you think perhaps the Bank of England will push interest rates down to? And do you know how long for? Because there is talk about possibly inflation hitting 1% next year, which, thinking, as you said, 12 months ago it was up at double-digit figures, going down to 1%. Might have they created too much scale within the market for people to stop spending?
Yeah, I think it's a tricky one, because we've had the CPI number out today, and I think they do want to see that go below 3. So if that goes below 3, as you mentioned, June, we're going to have a couple more CPI readings before then. So that should give the Bank of England some indication. So if that still comes through and it's a bit high, then, and above 3, then I think maybe they won't do it in June. And the next meeting's in August. And the August one's important because that comes with the monetary policy report, and they only do 4 of them a year. And that's where the Bank of England get more information on what's going on in the economy. And because of the fact that this is going to be the first cut, if I was in the Bank of England, I'd probably wait to that meeting. You get a few more inflation readings out. So I think the Bank of England might go in August. I don't know. It's like 50-50 between June and August in my head at the moment. I suppose it's the direction that matters, maybe not the timing. The ECB, I think, will definitely go in June. The Fed, again, probably 50-50 if they go June or later in the summer. I think the other problem with the US is just you've got the election around the corner, and the Fed is independent, and they don't want to be seen impacting the economy too much. Therefore, around that time, which is November time, which is going to be quite interesting to say the least as well. So, and as I said, I think it's not just one cut you'll see. Interest rates, the more normal level of interest rates that you should expect going forward is probably in the range of 3.5 to 4. It's not the only time we'll go back to kind of 0 or 0.5% like we did for 15 years after the financial crisis. Was when things were really bad. I don't think you'll go to those levels unless we get a very severe recession, which is not looking likely at the moment. These things can always happen, of course. So I think that will be the case, that we'll drift back down to those kind of 3.5% levels, because interest rates increasing takes time to filter through and impact the economy. People are still remortgaging through the course of this year, and they're going to be doing so with higher rates. So that's going to have a squeeze on their spending, which then impacts, how much you're going out and spending in shops and services, etc., which impacts the economy as well. So there's that still gradual read-through that's going to come through from mortgage rates going up, which is going to continue to slow the economy probably for the next few years, to be honest, because you think about, people that were remortgaging in 2021, then they, let's say on the best case scenario, they're on a 5-year fix. That's kind of 2026. So you can see it's still going to have a little bit of a drag. That will ebb down as the amount of mortgages are remortgaged. So there's definitely going to be impact still from that. And that's why the economy didn't really grow too much last year, because that's being felt through. But I mean, that's the, maybe the Bank of England are seeing that and thinking, oh, maybe we've gone a little bit too hard here. This is impacting the economy, which it obviously is, but they had to bring down inflation. And with inflation being more sensible numbers, they can start to take their foot off the accelerator and ease that pressure a little bit.
Good. So basically what we're saying, inflation's come down, interest rates have come down, and there's a bit to go still. Wage inflations are coming down, markets are up, so we're out of the woods, we're running, we're going forward, there's nothing to worry about. But you mentioned we're in a recession. So how can things be going so well on one hand and we're hitting a recession on the other? And with regards to that, how long do we think that recession is going to last for?
Well, so pulling that apart a little bit, as I said, I think it's not officially announced. It won't be officially announced until for another month or so. But I think the UK
is inside the knowledge they got.
But the UK is looking like, based on the data we've had for January and February and some of the PMI data, the UK is out of recession. So that's the positive. The other reason, so why are markets up when we're in recession? Okay, I'm gonna answer that one way and then provide quite a bit of evidence behind it, because this is one of my favourite topics. I'm a bit sad like that. So why is the markets up and we're in recession? So the first is the market moves ahead of what's going on in the economy. We've got a nice little chart which I'll demonstrate that in a minute. And just to highlight what I mean by that, do you remember the 23rd of March 2020, Stuart?
Yes.
What happened that day?
COVID.
That was, yeah, exactly. That was a day that Boris Johnson announced that we're having a national lockdown.
Everyone had to stay inside apart from the
key workers, people like you, key workers. But the other interesting thing about that day is that was the low of the stock market. Now, you wouldn't conceive that the day that a national lockdown was announced will be the low of the stock market, but it was, because as soon as a lockdown was announced, the market was then looking through that to the economy reopening, because there was a worst case scenario and it had already happened. So, and clearly, from March through to November, it was a horrible time for the economy, because we were in a lockdown still. I mean, in November, markets bounced even more because we had the vaccine announcement. So that's the first one. The other would be, and it's just weird coincidence, that in March 2009 was the low of the stock market after the financial crisis. But the UK, or the global economy, didn't come out of recession until the end of 2009. So you had 9 months of the market rallying, but the economy was actually in recession. And I'm just going to get up my favourite chart to just show you this now. And that's all because, as I said, the economy moves ahead of the market. It always has done. So now that we're these are some charts of markets bouncing back, just to highlight that fact. So here you go. So just 6 months returns for markets from the end of September to the end of March. You can see the S&P 500's up nearly 20%. The Nikkei, the Japanese stock market's up nearly 22%. Europe's up 15%. The UK has lagged a little bit, being up 7%, but it's still positive. And the only market that's down over the 6 month period is the Hang Seng market, which is the Chinese Hong Kong stock market. And this is the chart I was talking about. So you've got here the economy in this kind of the economy in this strong blue line here. And you can see that the market moves, which is this stock market here, this red line, 6 to 9 months before it. So you can see here that the market's already rallying as you're in recession, when you're coming out. And this is the period that we've gone in now. It was only a very mild recession, but nevertheless, as you said, it was a technical recession. The market's moved ahead, and now we're rallying through that. So that's the reason why the market's performing better. Market's not considering what's going on right now. It's thinking, well, what's happening in 6 to 9 months' time? When we get to the end of 6 to 9 months' time, as we said, interest rates will likely be down. Inflation will be down back to target by that perspective. And that could be stimulative for the economy. So that's the reason why the market's performing better, because it's looking forward over the next 6 to 9 months.
Okay. So do you think the markets may have got ahead of themselves a little bit? Do you think there could be a small correction, or?
I think there's definitely, there's always potential for correction, and corrections are perfectly normal. You have a correction every single year. A correction is technically a fall of 10% in the stock market. That would be perfectly normal to have, and that should be expected. Markets just don't move in one direction. So, if we did have a correction, I don't think it would worry me. Again, I think there's the way I'd answer that is corrections, and thinking about that is very short-term thinking. And we're focused on long-term investment, because that's where you make the best returns. And we would probably use any correction to add exposure. So, I mean, we're having a little bit of a correction this week because of the geopolitical tensions. So we launched a structured product at the close of play yesterday. And just based because markets were down 1.5–2% yesterday. So it meant we could lock in at a lower market level, and we got a higher return on the back of that. So I think that, corrections like that do present opportunities. Do I think markets have got ahead of themselves? Maybe a little bit. But what I would say is you're looking around at valuations, and that there's elements that look stretched, and we can touch on that in the US in a bit. But outside of maybe the top 10 companies in the US, valuations look very reasonable. And that's one of the best guides to delivering future returns, the price that you pay for something. So maybe in the short term, there's a bit of enthusiasm in there. But regardless of that, valuations at these levels still look very attractive, and you can still make decent, attractive returns from this point going forward.
And I think it's a good place to point out the way that at Pareto we encourage clients and the investment managers to invest clients' money is through diversification. And when we're talking about market corrections and volatility, the negatively or opposite correlated is bonds versus equity. So bonds do well, equities do poorly. In a normal market, bonds do poorly, equities do well. So even if there is a little bit of volatility, as you mentioned, that does give an opportunity to be able to lock in some of the value and buy to discount.
Yeah, no, absolutely. And we've been moving our bond position around a lot this year. So I think so in September last year, there was no expectation that central banks were going to cut interest rates. And we thought, well, that's wrong. So we added a bit of interest rate exposure within portfolios. But the market moves very quickly and overprices on both the upside and the downside. So when we got to the end of December, we were looking at it and thinking, well, now everyone's gone from expecting no interest rate cuts this year to expecting 6 or 7. And I was like, well, that's a bit of a head scratcher. So we thought, oh, we'll just reduce our exposure. And now, at the end of March and basically today, it's because of the stronger growth that we've got coming through, it's gone from 6 interest rate cuts to 2 or 3 this year. So you've gone from 0 to 6 back to 2 or 3. And we think maybe the 2 or 3 is more of a sensible level. But it does mean we are actively looking at our interest rate exposure and extending it again, because we, as I said, we do think it'll be coming. But it's a matter of when, as opposed not if.
Yeah, no, I would agree. And I think you've touched a lot on the macro and the fundamentals of what's happening in the markets. But there's still quite a lot of geopolitical risk out there. Obviously,
yeah.
We've still got Ukraine and Russia. We've got the issues in the Middle East. They've still got, you mentioned oil before.
Yeah.
I think on everyone's lips, as you mentioned in the last quarterly webinar, 50% of the population within the world are going to the polls this year. You smirked before when you were talking about the US elections. Let's not go there in too much detail. So what do you think the impact on portfolios could be with regards to all the geopolitical risk and that being high at the moment?
So I think when you get complex, it tends to be very short in terms of the impact on markets, equity markets and bond markets. It can have a bigger impact on commodity markets, as touched on. And that's fed through in impact of the inflationary figures. So let's take Russia invading Ukraine. Food prices went up because Ukraine produced a lot of food, like wheat and grains and things like that. Then obviously the oil price went up because there was embargoes on Russian oil. So then it impacted the global supply market of oil and refinery at the same time. And then obviously we had that natural gas issue. So that was a big impact because of that geopolitical event, which is obviously sadly still going on. Middle East is slightly different, and they'll all be slightly different because they all have different commodities. But the main one there is oil. So the oil price has picked up significantly. It's about $90. Just to put that in context, it was $125 immediately after Russia invaded Ukraine. So it's not nowhere near those levels, but it's certainly picked up and it had meaningful impact, which will be inflationary. So I mean, conflicts do have a short-term impact, and we've had about poor Monday, Tuesday this week because of that impact that's come through. As you said there, the market's bouncing back today because people are looking to take advantage of those opportunities and lock in at cheaper levels. In terms of politics, let me just share this so we've got these couple of slides here on that. I might have to escape this, sorry. It's not going to click through. Here we go. So this is the first one which I showed last time. You've got the economic growth impact at the top. You've got stock market returns on the bottom, going all the way back to 1947. Red, Republican Party; blue, Democrat; grey, divided government. You have recessions and bull markets during both parties. I mean, there's not a strong correlation here between what's going on with who's in charge within the US and the impact on markets. This is a new slide, though, that we've not shown before, and this is from one of our providers that we use, from Ned Davis. What they've done is they've looked at from 1900, this is the Dow Jones Industrial Average, one of the US stock market indices. They've got all the way back to 1900, and they've looked at every 4 years in the presidential election, and then they put them all together to create an average. So this shows the average of every presidential election cycle that exists for this market. And you can see here that this is 2024. So this is what, on average, if this was a normal year based on previous election cycles, the average return has been 7.4%. What's interesting is how markets behave during the year. So historically, markets are normally weak for the first 6 months in a presidential year. They then bounce very strongly. So it's interesting that. So we're kind of at June, and the expectation is, well, this year has been different to others because clearly markets have been very strong this year. But you can see there that markets, on average, they don't tend to worry too much about a presidential election. It tends to be a quite strong period for markets. You maybe get a little bit of concern here and maybe a few months before, but then markets tend to have a good rally towards the end of the year. And then you can see what's expected in the second year or the first presidential year after the inauguration, second and third, etc. So, historically, the worst year to be invested is actually this second presidential year when midterm elections are going through, etc. So that's the worst period to be invested. If you were just looking at comparing what's happened to history. Now, that doesn't mean it's going to happen this time because every election cycle is different. And some of the other important points is it matters what's going on with the economy. So, for example, in 2008 and 2009, it didn't matter who the president was because there was a financial crisis going on. In 2020, it didn't matter who the president was because there was COVID going on. So sometimes, and that's why I said right at the beginning, there's no strong relationship between what's going on with the economy or the stock market with regards to who's in office at the time.
And I think that's reflective of the UK also. We've got a general election coming up. I'm sure some clients are questioning what happens if Labour gets in, which looks as if they're going to. That's not me being political. But I think it's safe to say that general elections don't have a long-term impact really upon what's happening within the marketplace unless there's some definitive change in government policy.
Yeah, no, absolutely. And you don't need to have an election for change to come through. So just to provide an example of that, I've just got a puppy who's adorable and is a pain in the backside at times. But there was a big announcement just as we were getting in that veterinary services prices were being reviewed. And there was a lot of the listed vet companies then fell significantly on the day because basically they're trying to come up with standardized pricing across the industry. Now, that's a government decision that's come in straight away and impacted an industry like that. And that's not to do with an election. That's just because that's what the governments can do at any particular time. You know, and maybe the UK do it from time to time. China's the biggest one. I mean, the amount of interference from the government within the Chinese market over the last few years has been significant, and that's really impacting investor sentiment within that. I think the important point to remember about the general election coming up is both parties are quite centralist at the moment.
Yep.
Because so that should mean there's not going to be a lot of change. Another important point, and it's a really sad point, is we are very indebted as a country, which means that the wiggle room to pull here or there and try and get the economy going and different policies is significantly reduced. So that might have an impact on taxes down the line, who knows? But that's the reality of the situation we are within the UK economy at the moment. So that doesn't mean that a lot can be done. So that's almost a positive. I think what matters though, and this would be the key thing, is it's kind of showing it on that US chart. Markets like certainty. Markets want certainty. So it doesn't matter which party it's going to be. We all have our own personal views on that. Markets will just want the certainty of the event. They won't want a whole parliament. They will want a definitive answer. And I think that's really what the country needs as well. We need a party in time for a long period of time, because I think the UK has lost its shine on a global scale because of the amount of different chancellors and prime ministers we've had over the last 6 or 7 years. And just on that certainty point, I think the best example I can give is Brexit. So when we had the Brexit referendum in June 2016, now, clearly, that was a shocking announcement on that day, but the market rallied towards the end of that year. So again, because we had certainty of the event to a certain extent, maybe not in hindsight now, considering how long it's taken to get things done, but there was a bit of certainty there. And the other important point was that it was sterling that took the brunt of it. Sterling was impacted the most because of what the impact it was going to have on the economy. So sterling being weak was actually positive, because so much of the earnings within the FTSE 100 and the FTSE 250 come from overseas. So as sterling depreciates, it means their revenues go up and the profits go up. So it's just not nice if you're going on holiday because you're spending more to go when you're abroad. But from an investment perspective, it's not the worst scenario.
I can't believe you opened up the like can of worms, Brexit again.
We got Trump, we got Brexit, we got inflation, we got bring them all out today. Financial crisis.
But I mean, that's important when we're talking about. We've had the financial crisis, we've had Brexit, we've had COVID, we've had all the unrest in the Middle East and Ukraine and Russia. But is it safe to say that perhaps we're going back to a bit of a pre-2008 norm where you've got bonds and equities, inflation possibly being around 2.5%, 3%, interest rates coming back, because we've had a whole generation, and my daughters are at this age, 26 years old, she says, Dad, I can't believe interest rates are so expensive. And I'm saying, well, actually, they're not that expensive if we're looking at for a longer term.
Yeah.
So perhaps we have to get our head around going back to a pre-2008 norm, Alex. And
yeah, I think
markets would consider that as well.
Yeah, so it's important to remember that markets have, over the last 100, 200 years, have seen it all. So we've had we haven't even gone back to the Great Depression and recessions, etc., and wars that we've gone through over the years, and markets always chug along and hit fresh highs. So the other important development during the quarter is most major markets are close, if not hitting all-time highs at the moment. FTSE 100's a whisker off it. The S&P's there or thereabouts. Japan went through an all-time high for the first time in 19 years. So that, despite everything that's been thrown at us over the years, markets still carry on because companies adapt. They change. People's behaviour change. We work in the environment that we're in, and we deliver returns. I think interest rates being high is not a bad thing. You know, that money should not be free, because that means people make, as I said, bad decisions. And if interest rates are high, to me, I'm now looking at bond portfolios where we can get decent returns. So we're still getting 6 or 7% per annum yields on corporate bond funds at the moment. We haven't had them since 2007. So we can build low risk, cautious portfolios, but with the key element being corporate bonds, where we're going to be getting 6 or 7. We're buying government bonds where it's anywhere between 4 or 4.5% returns at the moment. Again, safe haven assets like government bonds with attractive-ish returns. And then we've got equity markets, which are pretty cheap. Companies are now starting to receive interest on the cash that they've got. So that's the other side of the coin. I mentioned the debt side, but if companies have got cash on the balance sheet, they're now getting a better return. Leads to more discipline in terms of thinking about M&A activity and what you're going to do with that capital, because there's a cost to it now, or a greater cost to it. And most companies that we look at have got very strong balance sheets and are in a very good position. So to us, you know, when you're starting at this low valuation, it's an attractive time to be invested in equity markets. And equity markets have done well when interest rates have been high in the past. It's just we haven't had to think about that for 15 years or so. So for me, when I'm looking forward, we're pretty optimistic over the coming years, because for the reasons I mentioned, you get good returns available from bond portfolios. You're getting good returns potentially from equity markets based on valuations. So and look, there will be corrections through that. There will be other events that happen. There will be political change, but we will take it in our stride, because this has happened time and time again over the years, and we just adapt to the environment that we're in, and we do that very quickly.
I'm conscious of time here, but effectively, Alex, what we're saying is it's a good time to invest.
Sorry, Stuart. I mean, one of the things you mentioned, it's time in the market, not time in the market. And you wouldn't have expected, it came out of nowhere, the last 6 months where, as I said, you've had stellar returns out of most major markets. And we were getting a lot of questions in the summer of last year saying, shall I disinvest? And we kept saying no, because at some point there will be a rally. We don't know when it's going to be. Yeah. But you know, sadly, we did lose a couple of clients at that point, and they went to cash. So they made a decision when investment markets were weaker to disinvest, and they've subsequently missed the rally that's happened over the last 6 months or so. And that's why, you know, back to what you said, it's time in the market, not time in the market. It's wrong. It's very corny and very cheesy, but it's really important. You know, think about the long term, because, you know, in the next 2 months, I don't know, something really catastrophic could happen within the Middle East. It could really escalate, and markets will be weak. Yeah, but equally, then the market will know that's happened. Economic growth can improve, and you'll have a rally. I mean, we were talking about Russia, Ukraine, and we still are, but we don't talk it from an investment perspective anymore, because the market's moved on from that, as sad as that's horrible to say. So these things will happen, and they will have a short-term impact, but over the long term, they will look like tiny little speed bumps on the investment performance that portfolios deliver.
Well, Warren Buffett's favourite saying is swim against the tide, not with the tide. So when the markets are down, that's the time to get in. When the markets are high, that's the time to look at taking some of the value out. I think it's important just to point out to any clients that are out there, I would agree we had clients that were questioning why they're in the investment market while the funds have dropped in value and they could get 5-6% sat in cash. One thing to bear in mind is obviously cash rates are usually temporary. We've spoken about interest rates coming down. That will follow cash interest rates coming down that you'll get in the bank, and possibly looking at some of the 12-month fixed cash rates that people tie themselves into will be coming up for renewal. We have looked at bond portfolios with yourselves, and an alternative may be looking at, rather than cash, going into a bond portfolio, and some of those returns can be tax-free, can't they?
Yeah, so I'm just going to share this chart very quickly, which just highlights that. And that's a really important point. So if you're invested in, so it's gold, oil, if you're invested in a, maybe I don't have it today. Sorry, it's not in it. doesn't matter. So sorry about that. So the important point is you are taxed at your marginal tax rate for cash returns. So if you're a high rate taxpayer and you're doing a disclosure on your self-assessment, you have to disclose the interest, which means you have to pay income tax rates on cash. Now, most of the government bonds that have been issued over the last 10 years, because interest rates are low, have been issued with very low coupons. So if you buy a government bond, yes, you have to pay tax on the income, but that's very small at the moment because of the potential returns, say 0.5%. But the other important point from buying a government bond is the price that you pay from it. Now, most of the government bonds that were issued at 0.5% interest rates are now trading at 85 to 90p, depends on the type of maturity that you're looking at. And what happens with bonds is they mature at 100. So they're priced at 85 or 90, but they're going to mature at 100, let's say in 2 years' time. You've shown some shit. Here you go. You're helping me out. Thank you very much. There you go. So just as Stuart said, these are all the bonds that are issued since 2024 to 2026. You've got all the bonds on the left-hand side. You've got the maturity dates coming up. There's the coupons. You can see that the coupons are very low. Let's just focus on that 0.18 Treasury 2026. You can see that's at 0.125%. As I said, it's priced at £91 at the moment. So the return, which is this next column, there's two elements to return that you get from buying a gilt. Is the return of the price going back to 100 and a little bit of that coupon because you're getting that every year. So that's a 4.4% return per annum from that bond until it matures in January 2026. Now, because most of that return is tax-free, because it's the return of the price going from 91 to 100, you go all the way to the right and you're a higher rate taxpayer, you need to be walking into the bank and getting a 7.26% return to get the equivalent return of what that bond can deliver you from a tax perspective. And there's no, trust me, if there's no interest rates out there that are going to be getting you a 7.26% return over the next 2 and a bit years. So to us, that's a very tax efficient way of looking after your savings. And we have been doing loads of these. So tens of hundreds of million within these bonds have gone in because we've been making this point several times that this is a much tax efficient way to look after your money than just putting it in the bank. I think the other important point to mention as well is, well, what's the risk? Now, the risk is that the UK government defaults because this is buying UK debt. Now, I'd hate to think we're in a scenario where the UK government defaults on its debt. And the alternative to that is you've got money in the bank and the bank could default. Now, what's the probability of a bank defaulting? I think it's pretty low as well. So I don't think we're going to see any banks going under, but I'd suggest that the risk of the government going under is even more. So your money's safe to a certain extent. It's not in the financial services compensation scheme, which you are protected with when you've got money in the bank. So that is an important consideration to be mindful of. So yeah, that to me, it's a very attractive asset class to be thinking about if you've got excess cash and you want to be more tax efficient with the returns that you're getting on it.
Good. Well, Alex, thank you for that. There's a couple of questions here, and I am conscious of time. You've mentioned that markets are good. Some are at an all-time high, or most are close to the all-time high. Where's the potential for any value?
I think there's value across globally in different equity markets. So the UK, as you mentioned, has really lagged compared to what's happened in global markets over the last 6 months. So it's up 6%, whereas the US and Japan's up 20%. So there's not a lot of euphoria about UK assets at the moment, and mid and small cap as well have bounced significantly. But interestingly, March, the FTSE All-Share was the best performing market. So it shows that it is making a bit of catch up at the moment. So the UK is certainly in catch up. I think the other important point is we touched on the Magnificent Seven. Valuations within the US look pretty stretched within its top 10 companies, but the rest of the US market looks reasonably valued. Japan, despite its rally, looks fair value. So I think you can still deliver good returns from Japan. Europe is similar to the UK. It's been depressed for the last couple of years and is starting to recover and been a bit better than the UK. So I think you still make decent returns in Europe. And if you want to take a bit more risk, China has been a horrible place to be invested over the last 3 and a bit years. The Chinese stock market's gone down for 3 years. So it's been a terrible place to invest. But as we said, all these things are cyclical. Chinese growth's improving. People get a little bit more confidence investing in China. Who knows? Then that could be a good place to invest. So if you're a high risk client, of course. So I think, kind of touched on nearly every global equity market there, which looks fair value, if not cheap in certain cases. There's definitely a bit of overvaluation in some part of the market. Outside of the equity market, I mean, we've just been talking about gilts. They present attractive returns for lower risk clients. And as I said, if you want to take a bit more risk and buy corporate bonds, so buying bonds from BP, Shell, Tesco, etc., Vodafone, then the returns available on those type of bonds are pretty attractive too. So maybe 6 to 7%. So I think we always say, and this is the returns that we're saying for a balanced investor, maybe 6 to 7% over the long term. But based on the fact where valuations are at the moment, over the next 10 years, we could probably increase that to 7 or 8% because of the returns available on the starting valuation. And that's being conservative. It will never be 7 or 8% every single year. Obviously, we'll have drawdowns within that, but that's what you'd expect to get over the long term.
You mentioned the Magnificent Seven. I know you've been a proponent of it in terms of have they been overvalued, but I don't think AI is going away anytime soon. It's going to have the opposite effect, which is driving some of the values. I don't know if you want to just quickly.
Yes. Yeah, sorry, Stuart. So there's a few points. I mean, I think that there have been some cracks within the Magnificent Seven this year. So Nvidia's done very well, but Apple's been under a little bit of pressure. Tesla's been under a little bit of pressure. Microsoft's done well. So you are starting to see a bit of divergence, which is interesting because we didn't have that last year. They were all going up together. Valuations are high, and I always think that the most important thing when you're investing is the price that you pay for something. So that's what makes me a little bit nervous. And I think if you go back to 99, what people were saying then is the internet's not going away, but then you didn't make any money out of tech stocks for nearly 8 years because they were so expensive when you were buying them that you locked in negative return, excuse me. So that's what makes me nervous. And like you say, we want to be diversified. We don't want to just be exposed to one theme. And it's an important theme. Like you say, it's not going away. And it will have significant change on the way that we work and our lives over the next few years for sure. And it's irreversible after it happens as well. So it's going to be there for all time. And obviously technology just develops and develops. So, and there will be winners from it. Where people are able to deliver higher revenues. Nvidia is the big one because of the processing chips that it generates already, which are being bought like crazy by most of the big tech companies just because they want to invest in this because they see the strong gains from it. So they've been the early advantage winner from it. There will be other winners that come down the line that they develop their business to be so successful and help individuals so much and companies so much that they can deliver higher profits from that. We haven't seen that yet. That's the next level, what we're going to see. It does feel like every time anyone puts AI in their company reports, their share price jumps 5 or 10% at the moment, which when they haven't done anything, I'd like to see some proof in the pudding come through as well.
Thank you. Well, that's all the questions and answers. Alex, as always, thank you for presenting today. For those of you who are regulars on the quarterly webinar, you'll know who Alex is, Chief Investment Officer for Luna. For those who have just dialed in for the first time, Alex has won a number of accolades, including the City Wide Top 100 Wealth Managers, Selector UK 30, Private Asset Management, Top 40, Under 40. That must have been a good few years ago, Alex.
Was a while ago.
Everyone, thank you for dialing in today. It really is appreciated. The next quarterly investment webinar will be in July 2024. let's see what Super June brings, if we've got any more information on Bank of England's interest rates. If there's anything that anyone would like to discuss further, clients or introducers, please feel free to speak to the advisor. I think what I'm taking away from this is what we've been saying in previous webinars has actually come to fruition. Timescales we don't know, but again, I'll reiterate the point, time in the market, not timing of the market. If you miss those 10 best days, then to play catch up, you're out of the running. It'll affect your returns massively. So please feel free to speak to ourselves if you like an assessment of any of your investments, see how they're doing, reassess your risk volatility. Your advisor or myself are more than happy to help. Hope everyone has a good day. Football tonight, and hopefully the sun will keep shining for the rest of the summer. Fingers crossed. Thank you, everyone.
Thanks, everyone. All the best. Bye now.